What's up, everybody? Welcome back to another episode of the Outlier podcast. I have my friend Tom Basso back hanging out with us, really to ring out the year. This was the last full trading day of 2023. So stoked to finish the year off with you. Thanks for hanging out.
Yeah, I just finished up my afternoon run 10 minutes before we got on. So yeah, this is the end of the year.
It was
I head
beautiful.
into the long weekend now.
How was your run? What'd you do?
Oh, I just did. I had a down day today, but it was a pretty good year,
Yeah,
all
that
told. Yeah.
that's absolutely awesome. So when you look back at 2023, what stuck out to you? What was anomalous? And the reason why I asked that question is because you've seen a lot of markets, right? So I started trading in 2007 myself, and I know that you've seen much more than I have. So I'm always curious to see what kind of things stuck out to different people with different reference ranges.
I think that I guess the two major things I noticed was that I completely would have never predicted that the stock market would be almost at new highs at the end of the year. I figured the economy was probably going to go into a more of a hard landing, not a soft landing. And I still don't know that we're going to have a soft landing. I think that's the jury's out still a little bit on that. So we'll see next year how that works out. But the one thing that surprised me is the strength of the stock market because it seems to be running on fumes almost. Some indicators that are strange. I have a stock index trading strategy, and despite the fact that on the last 5, 6 days, the market has made highs each day up to today, so through yesterday, I noticed that I couldn't get any of my overbought, oversold indicators to overbought. I thought that was interesting. It's kind of like the strength isn't there to really peg the indicators out, but it keeps trying to hang on and go up more. Today, of course, it didn't, and we'll see whether that spills over into a lot of tax selling for next year early or what. That was the one thing that was interesting, and that really propelled some of my returns for the year. I wouldn't have expected it. The other thing that was, I thought, strange and quite profitable and very good for me was that, the all-weather strategy trades like 26 different futures markets, and I noticed a number of them just went nuts. Like orange juice had this huge move earlier in the year that blew my mind. And then, what goes up comes down. So all of a sudden it turns around, goes the other way, and you make a bunch of money the other direction. Coffee had some big moves. A lot of the soft commodities had some just really violent, um, just crazy stuff. So that's been helpful for profits. The rest of the stuff, you know, it just isn't worth worrying about. Some profitable trades, some losers, all came out in the wash. I think the big highlights were the some of the softs commodities moves that we saw, and then some of the in the stock market through the year end.
When you look at your returns for the year, what was the primary driver of the performance?
I could joke around and say trends. The trends were the driver. If you have a trend, you can make money. If you don't have a trend, you can't. Mostly, I'd say the stocks at the end of the year were huge. The move earlier in the year was profitable, but it stopped me out about half of the positions. So the ones that hung on were really, really quite profitable for the year. The ones that got stopped out, I had to get back in. They're mildly profitable, but through the year end, that was one big area. And the other area, I believe, was the futures. The commodities really had some strange stuff. I mean, you had wheat doing weird things with Ukraine. You had orange juice, crazy. Coffee had some crazy stuff. There's been some very interesting moves in the commodities. So that's been very profitable because the trends are hang around long enough for you to really coin some money off of them. that's probably the two major areas I thought there was quite a little driver of profits.
Another question I had for you is what did you make of the move in the beginning of the year? Because I thought it was fascinating going from the open to the highs that we saw in early February, essentially back to where we opened the year in March. And then obviously it was off to the races from there. But I just thought that that movement followed
Right.
by what we saw was very curious. I don't know what to make of it. I'm curious if you have any thoughts on it.
Of course, I just follow my indicators. I don't predict a lot at all, actually, when I'm trading. I saw that as a feeble attempt to try to get a bull market going or a bull move going, and it failing, and it stopped out about half of my positions. The hedges actually went on. So I was hedged for a little bit there, and then I got whipsawed out of the hedge, and all the longs started coming back in, and all of a sudden, right now, I'm 30 out of 30 sectors long. Everything is long. It's clearly that early move was a fake out and a test, and then we got back on the train, and right through the end of the year, it has been just a crazy move up, I think. I have no idea whether it'll be able to hang on in the next year. I'm not going to even bother predicting because it doesn't make any difference for those who want to try to predict. I'd say that all I would worry about is to be ready to react quickly, expect potential for it moving very fast because there's so many people with so many profits built up, so many nervous Nellies about what might happen. If you get some tax selling causing it to be loose early going here, and then any kind of incident, just out of the blue, something happens economically, the Fed, the wars that we seem to be in, anything could touch off the flame, and then all of a sudden, man, everybody be trying to get out the door at the same time. It could get ugly. So I just be very careful here. It just seems to me like there's so much volatility and so much potential for disaster. I just enjoy the ride while you can to the upside and be prepared to do the other if you have to.
What do you make of tech's overall strength? And I want to open the question up a little deeper than that as compared to just 2023. From your studies of the markets, what other references do you have where a single sector has single handedly done what tech has essentially done over the last 5 years, if anything?
Well, not over the last five, but if you go back to 2000, which would be getting ancient history for a guy your age, probably, the tech bubble in 1999, 2000, that was earlier internet, and the tech stocks were just nuts. They were all losing money. There were IPOs were coming out, and they'd rate a company hundreds of millions or billions of dollars, and they hadn't even made a profit yet. It was just insanity. And you looked at that, and everybody said, "Well, yeah, this has never happened before, and it is very overbought, but it's a new market. This is never happened before because we've never had all this technology that's going to change our lives and all this stuff. And eventually the profits will come." And the lesson to be learned is the tech stocks ended up going down 80% shortly thereafter. Now, if you fast forward all the way to now, a few tech stocks like Amazon, Facebook, or Meta, and Google, and so on, were able to, figure that out, survive that debacle, and end up, making a ton of money over the last couple decades. But th- that kind of what's happening in tech now almost seems to be a little, well, there's the AI spin, which I don't know that anybody's making money off of it yet. They're pouring a lot of money into it. And then you've got the tech stocks in general. You've got competitions, you've got multi-billion-dollar fines coming down from the EU for some of these people. You've got I don't, Amazon's not the powerhouse it was. I mean, they're trying to now run ads on Amazon Prime to kind of make some more money there. You know, I think there's going to be competition if the economy goes south. Then a lot of advertising is going to dry up. A lot of Amazon orders are going to still, kind of dry up a little bit, or at least people will spend a little less. It could get a little ugly if everybody gets the momentum going the other way for a while, because everything's sort of been overdone lately. And there's those that will say, it hasn't been overdone. We could, with AI or with a booming economy, all of this stuff could still make even more money. And there's new tech stocks that are coming on all the time, and they could make money and all that. I just think the stock market is very, uh, just kind of a little nervous right now. And it's been such a good run, and I don't think the economy is going to do that great next year. I'm not seeing it. I still think soft landing could be tricky. Fed has never been lately, for the last few decades, probably very good at fine tuning the economy. I think they'd be better off to let the economy fine tune itself and sort of get out of the way. But if the economy doesn't really, if they've gone overboard and the economy slows down and all the numbers start getting ugly, and we have down interest rates coming down, not because the Fed is pivoting and going to be spurring on the economy, but because the economy is just doesn't have the demand for money anymore. It's people are can't afford a house. They can't. So you can't get a mortgage if you can't afford a house, right? I mean, so there's not as much demand for mortgage. I don't know. There's a lot of things that could happen that just seems like the economy could go soft. If that happens and it trips up the stock market, then it goes soft. And you got everything kind of caving in at the same time. And then how do you hide from that? If you're just a stock trader long, you've got no place to hide. You have to just patiently wait it out. If you're an all-weather trader like me, you start looking at other opportunities, your short bonds maybe, or your long bonds, and trying to get the lower interest rate cycle. You're maybe got gold going on, silver, maybe you've got platinum. You got things, aluminum to the short side. You got softs maybe if there's inflation. You got a lot of food stocks or food futures that you can deal with. So there's profit opportunities out there, but you got to be a little bit non-traditional to figure that out.
What do you make of crude oil here?
Uh, well, crude oil's been kind of the last few months sort of going on the sideways range. It's getting a little soft just real recently, on last week or so, but it's been kind of sideways. There hasn't been much major move. Earlier in the year, there was some nice moves that were profitable, but lately it's been kind of trying to figure itself out. I noticed gasoline or unleaded gas went to the downside. Crude oil's going to the downside, and natural gas actually broke out to the upside. So whatever that means.
Yeah. Well, nat gas, it always feels like kind of the crackhead of the bunch, because I feel like you never really know where nat gas is going to pop up and what it's going to pop to.
Yeah.
Um, Looking at it from, I guess, a macro perspective, what do you think about the extended war in Ukraine? And do you think what's going on over there? I know we kind of got a bit of a pass, so to speak, because it was a bit more of a mild winter. But
Mhm.
if this engagement continues into the next year and we have a less accommodating winter, like what do you make of something like that?
Yeah, I mean, then all of a sudden we need energy, and we've done our best to mess up our energy grids and with non-fossil fuels that are not reliable, that aren't consistent. We haven't built nuclear fast enough. Uh, it's ripe for having disruptions, and it's people don't realize that. I think the entire energy industry is on kind of like a couple week to 3 week turnaround. I mean, you got to get the stuff out of the ground, you got to get it through the pipelines, you got to refine it, you got to get it out there to burn it. And there's not a whole lot of long lead time to that. There's a lead time to drilling and to finding new supplies and getting all that set up. But once it's set up and producing, it's from the time it comes out of the ground to the time it's going into your car is pretty quick. And so it doesn't take much to disrupt it. And if you continue to have shortfalls and then you have something like a weather event or a war, it's pretty easy to disrupt the prices. So I like the market as a trading vehicle because, again, if markets move, you have the potential for profit. If markets don't move, you can't make a whole lot of money in it. So I trade crude oil, I trade unleaded gas, and I trade natural gas in the energy complex.
Yeah, and you brought up an interesting point as well on the nuclear energy side of things, which I find fascinating because I live in San Diego and there's
Mhm.
some nuclear reactors like right on the coast, and they're in the
Yep.
process of dismantling it. They're taking them apart.
Yeah.
And I find that just so hard to understand. If we're trying to create a more efficient energy source, it seems really difficult to find something more efficient than nuclear reactors, at least that we have that's scalable right now. Yet, obviously, there are disposal issues. And that's almost like a future us problem, which is always difficult. You don't want to kick the can down the road too far because then you have to reconcile it at some point. But it's interesting to me to see the direction we're going with that. What
Yeah.
do
Well,
you? Sorry, yeah, go ahead.
in California's case, I think they're nervous about your nuclear reactors being near earthquake zones. And that's the problem there. We have uh, Palo Verde here, um, over here in Phoenix, is generating lots of cheap power, and we're not in an earthquake zone here, so there's no discussions of dismantling that or anything. I would imagine most people would want to have more of Palo Verde. It's done a great job of keeping our costs down on energy, and we sell some of that over to you guys.
Yeah, and it's interesting too because I could see the idea of earthquakes, but down in San Diego, we really don't get them. We're not near much of those massive tectonic plates. But I was looking at the trend across the US out of curiosity. In 1990, there was 111 reactors. And as of 2023, we're down to 93. And it seems like we're continuing that direction. One of my ideas, though, is I feel like while we might think that's a good environmental decision in the short term, I imagine we'll come to a point where we realize, like, oh shit, this is actually not working. We're not having a stable system anymore. We need to build more of these.
Yeah.
Is that some, like, I don't know how closely you follow power. I know since you trade futures, you probably have at least a peripheral understanding of it, if not a
Yeah,
deeper. But I'm curious what you think of that.
I came really close to studying nuclear engineering in college, and I ended up in chemical engineering instead. It all came down to the scholarship flows from different universities,
Mm.
and my best deal was at Clarkson, and they didn't have nuclear engineering, so chemical was my pick. And I really love chemistry, so it was great. But and it all worked out in the end. I can't kick too much about my life. Has been pretty blessed. The I'd say the nuclear side of things is that I think you got to ask yourself globally, and if you do this in today's world, and you ask yourself with the demand that we have for energy, how are you going to supply it reliably? Nothing I'm seeing coming out of, say, the current administration at all makes any sense to provide the amount of reliable energy that would be necessary to do the things that they seem to want to do. Like if they want everybody to drive an EV, you got to have electricity. We have all sorts of coal-fired plants. Wind energy and solar are not reliable and are not cost effective. They will destroy our economy. There's no way you can come up with enough energy to satisfy the needs in the United States or the world without fossil fuels. So, with all due respect to anybody who wants to do something, the reality is you can't. It won't work. Nuclear is sort of the kind of thing where you do have some problems with it on disposal, but it does generate inexpensive power. Part of the reason it is so expensive to put one of those in is all the regulations and stuff the environmental impact, everything else. It seems like the anti-nuclear crowd has gotten involved in making nuclear reactors very difficult for new ones to come on stream. But that would probably be the most environmentally friendly, probably cost effective once it's in, type of way of producing energy. Sadly, there doesn't seem to be the amount of enthusiasm for it that you and I might have.
Yeah, and I'm curious if there's going to come a point where we realize we have to make some changes, because I know Elon Musk actually has talked a couple times about this interesting concept where I don't know the exact size, but a relatively small solar farm could be built and power much of the US if it's put in the desert. Actually, I don't somewhere in the Southwest. I don't remember exactly where he was talking about, maybe
You mean a
Nevada.
small nuclear?
No,
Or
actual solar. So I'm curious.
I don't believe it.
He's convinced. He says that, and it's not a big. Actually, let me see if I can find it real quick, because it's really interesting. Because part of me thinks if his position on that influences stuff like this market, where people might be thinking, well, if this does work, then I mean, to Elon's point, this would definitely be better than.
I would disagree in that I've done some research on solar. The amount of solar in the middle part of the day, and I live in Arizona, it's sunny 330 days a year here. So we do have some solar, but the amount of solar power that actually comes into a square footage area of the earth, unobstructed by clouds or anything else, is a certain fixed amount of energy. You can't even capture all that energy. Yes, I admit it's free. Collecting it is not free. You got to buy the solar panels and all that. And current technology, they can only get a fraction of that very limited energy per square foot. If you take that and look at what kind of energy needs you have in the world, there's just no way that solar will provide it. It
Yeah,
can't.
I found the line that he was talking about, and he says, this is a quote from Musk during a podcast with Joe Rogan, and it says, this is from Elon Musk, and he said, you could actually power the entire United States with 100 miles by 100 miles of solar, which is an interesting idea. Obviously, you need batteries, all that kind of stuff to support it. And I think it's kind of like, I think that there's a pretty fair probability of what we saw with windmills. Again, that's another thing we have out here is windmills, and a bunch of them just, they don't windmill anymore. Some of them are working, some of them aren't. And we found that there's very little juice that's not worth the squeeze for windmills. So part of me is curious if we would find something like that, but also who knows, the advancement of technology. But I think to your point, anyways, we have something now that does work. We know it works really well. And we're kind of going the other direction.
Long term, the energy solution to all of this, and it would just completely disrupt the world and turn OPEC upside down and everything else would be fusion. They've now run fusion energy and created a net positive, and they've replicated it 3 times in 3 separate tests. So it's not a fluke. It's not just a measurement problem or anything. Now that they've replicated it 3 times, now we got to figure out how to make a fusion plant out of it and keep collecting that energy, because now you have all the fuel in the world right off your shore in San Diego. You just take water, you get some hydrogen, and away you go. And now you've got as much energy as the world would ever need, and there's zero pollution. The
That's I
fusion energy ends up combining together the hydrogen molecules, and you end up with water vapor coming out of the other side of the reactor. So there's zero radiation.
Yeah, I saw a really interesting thing coming through from Toyota that they had built a hydrogen fueled car that essentially works off of this thesis. I I
No,
think
that's the no that no no that, I know that one too. That's a hydrogen fuel cell. So
right,
that would be a different wrinkle. It would not be fusion energy.
right,
Fusion
right, right.
energy you could do in a power plant type setup, just like Palo Verde over here. You could set up a fusion part of the plant, and it would just generate a lot of heat and therefore steam, and therefore drive the turbines and create the electricity, and you'd be able to power the grid. And if you had a supply of water, you'd have just an infinite supply of water. You'd have an infinite supply of energy, and
Right.
you would be able to power the earth really easily. And once you got it set up, if it could be self-sustaining without a whole lot of moving parts, you could really create some very inexpensive energy, and OPEC would just be gone. You wouldn't,
They would lose it.
you'd
Yeah.
power then. Now, when you have zero or very low cost for energy, now you have different options for trying to have grids that allow, say, electric cars that aren't running on batteries. You might be able to, have commuting with induced electricity into like a
Like a
driverless
third
Uber
rail
or
almost.
something. Like, it's hard to imagine what you could do, but fusion energy, if you could drive the cost of energy down so much and make it so abundant, that would disrupt the world huge, and for a
Yeah.
positive way. And it would get
Yeah.
rid of fossil fuels for all those that think there is a global warming or cooling or climate change or anything. That should satisfy them, because you're getting no radiation, you're getting no byproducts, and you got very inexpensive energy. So that would be, a good thing there. And smog and those types of things would be way down, because you wouldn't have any, burning hydrocarbons. Um, so all good, but so far that hasn't happened yet. I keep
Yeah.
hoping.
Yeah, I'm always curious what the motivation is behind those things. And what I was referencing earlier, I actually do want your thoughts on this. Is so Toyota, they're looking at the hydrogen combustion engine, and really what I was tying it to is the use of water and how we're trying to use water for different energy sources. But what I was reading, you probably know this better than me, is that they're seeing that those kinds of engines actually release a lot of nitrogen, which leads to other potential issues. Which, do you think that there is a future for something like hydrogen combustion engines specifically, that, like the Toyota is trying to develop? It's still early. They really get terrible mileage. They're underpowered, just like the beginning of any, combustion engine. But
Well,
I'm
I'm not
sure
sure
the
it's combustion. I think it's hydrogen fuel cell. So,
at least the article I'm looking at now calls it hydrogen combustion engines, and it
okay,
says
well,
that
that
they
would
are
be a possibility. You could do that. That would be a little trickier, because now you're going to burn hydrogen, which is extremely burnable, and you're going to have that engine be able to withstand the forces of hydrogen combustion. So that, yeah, it's doable, but I wouldn't think it'd be easy as burning gas. So yeah, good luck to Toyota.
probably cost prohibitive still. Yeah, because the other thing I found in there that was interesting is obviously you need like these pressure tanks that then, if you get into a car crash, doesn't lead to a mini atom bomb going off.
No, that wouldn't happen, actually.
Okay,
You have a better chance of having an explosion with gasoline than you do with compressed hydrogen. Is if you
got
crack
it.
that with the hydrogen, you would you would pretty much just have an escape of gas, and it would be a very quick, violent little, like puff, and then that would be pretty much it. You would not be able to create
Like
enough
an actual
vapor cloud to
explosion.
create the explosion, I don't think.
Interesting.
So
Yeah.
I think hydrogen actually, I think, as a compressed gas could be less dangerous than I believe gasoline is. If you have a rear end collision in a gas tank and there's a spark, you could blow up a car.
Right. Interesting. Yeah, I'm actually always fascinated by the different advancements that we see in auto because to your point, when I think about something like OPEC, I also think about automotives. That's obviously a
Mhm.
massive part of that equation. Um,
Mhm.
a couple other questions I had for you from a few things you touched on earlier. The first one is you were talking about early in the year, your hedges coming on and getting stopped out on some of those.
Yep.
I wanted to level down a little bit from where you're at in the way that you trade and to put it into the perspective of a smaller, newer retail trader. What are some ways that you think that they could apply a similar methodology where, based on current market circumstances, hedges start to scale on by themselves, essentially?
Well, the way I think the simplest form is to not be exposed to the risk by getting out of the risk. So the very first thing I'd consider doing is looking at your portfolio and asking yourself, is there any way I can just set up some trend following models on the tickers that I own? And when the indicators go south, you just bail out of them. You just sell off those positions. You're never going to get the top when you do that, but you'll be able to hopefully avoid the 80, 50 to 80% down market that could happen real easily with how extended we are right now. Um, the hedge idea that I use, it gets a little bit more one level up on the sophistication, because what you're doing there is you have a portfolio long. So let's say you've got some names, if Amazon or something like that, you could sell that in a second. I don't know how many times a second Amazon trades, but I'm sure there's such a liquid market. You can just bail out of it and go to cash if you want. But let's say you're into some kind of XYZ high tech, small, not so liquid type company, but it's done real well. You want to preserve the profits, you like the thing for the long run, and you want to hedge it. Well, then you're going to be mostly affected by the stock market itself. So take the S&P or the NASDAQ might be a good choice if you were the tech stock, and just set up a tracking. It could be a moving average. It could be, a Keltner, Bollinger Band, Donchian channel, any one of the above. Invent your own if you want. Point and figure bar chart would work. There's lots and lots of trend following models out there and lots of parameters associated with those models. And what I would encourage an investor to do is to look at his own time frame that he's concerned with. Like, I tend to just be sort of a 1 month time frame in a lot of my indicators on the longer term stuff. So 21 business days or 21 trading days is about a parameter where I see I'm comfortable with measuring what the markets do. Anything inside of a month, I really don't want to take a lot of actions. I don't want to be long and short 3 times inside the month. So 21 days to me is my parameter set for a lot of my longer term stuff. And I've even gone to one step further than that, to 50 days for hedging to the downside. So when that goes over, though, when I have a 50-day parameter indicator set that says the direction now is down, you have your choice. Do you want to get out of all those stocks, which it might be, you might have 10 or 15 or 20? Or do you want to just put on one index trade to the downside and kind of balance those two? So on the one side, you've got your stock portfolio to the upside, and the other side, you put in place sort of a negative position that tries to make money this way. And no matter what happens in the market or your stocks, it sort of just balances out. So to me, it's just easier for me to do a calculation of my portfolio and say, hey, if I put on X amount of contracts of Standard & Poor's 500 futures, I'm hedged. it's like a non-event now. The market goes up, I make no money. If the market goes down, I make I don't lose a lot of money. I'm just basically flat. But to me, it's easier to take the one transaction on and off than to try to deal with a whole portfolio of like 30 sector ETFs, which each have to have their own individual stop orders, and you got to maintain those, and you got to do all that. I think the other key wrinkle here for the average new investor that wouldn't think this through very well is if they have enjoyed a nice year in 2023, and let's say they had 10 issues and they nailed the bottom and they've had a great run, chances are one or two or three of those are a lot bigger in terms of their percentage of the portfolio than they were at the beginning of the year. And something I'm a big believer in is trying to keep the portfolio as balanced as I can within reason. I mean, you got to give the issues a little room to move and make you money. You can't be constantly taking off profits if the issues just barely moved. So, but what I mean is, let's say you've got, I don't know, say you did 20 stocks and you ended up 5% in each of 20 stocks, and now your portfolio is nicely ahead, say 20, 30%. But it turns out that you no longer each have 5% anymore, because three of your positions are now 10% each of your portfolio. You should consider, and I wrote the book on, successful traders size their positions, why and how, because I think not very many people do a good job of managing their existing positions. So what you could consider doing is rebalancing your entire portfolio, which will mean forcing yourself to take those 3 or 4 stocks that ended up making a ton of money and are now throwing your portfolio out of balance. You try to bring it back into balance. You maybe stay with the issues you already have. You maybe peel off some of your profits from the ones that are doing great things. And I'm not saying to sell at all. I'm just saying to get the portfolio back to balance somehow so that you don't have that exposure to the 3 names that have done great things and are a significant part of your money. And if those 3 things go against you now, they're going to be a significant part of your drawdown that's about to happen. By peeling things off, you're modifying the exposures so that you smooth out your track record, and you'll reduce that first part of that next drawdown you're going to suffer sooner or later. It might be 2026, but whenever it happens, you're prepared for it, and you've actually pre-positioned your portfolio to be balanced, which means you're going to minimize the effect of the downswing. And so many traders, have a struggle. The reason they're not Mr. Serenity, my nickname there, if you properly manage your positions and keep everything balanced, and you think ahead and you get prepared to put hedges on, you get prepared to time out of positions, you get a market that turns around, goes down 50%, you take it in stride. No big deal. You're ready for it. If you're not prepared for it, it's hard to be serene about it because you're watching the market shred your portfolio. So that's the key to success long term. And I've been through so many bear markets, I've lost track how many. But I think it seasons you and it gets you preparing ahead of time to deal with it so that you're not caught by surprise.
Now, another thing that you mentioned during that I want to key in on was the purpose of the hedge and how you tie it to a few different factors, one of which being if you're in a product that's less liquid and the target might be moving a bit as you're trying to find the door. I think it's an important point to linger on briefly, just because I feel like a lot of retail traders, they come across the idea of hedging and they think, well, this is great. Now I make money in all directions. Obviously this is the coolest thing ever. And I think a lot of traders forget the fact that a well-deployed hedge is going to serve as a drag on your returns. And you accept that. You accept the fact that you are not going to achieve the other gains you potentially could because you are reducing volatility. You are carrying this hedge.
Yeah, I
I
call it
think
fire insurance. You really don't want to ever collect on fire insurance, but if you have to, it's sure nice to have it. I don't want a stock market going down 80%. I don't want another depression and have to live through that. I don't want even 50% down on the S&P like we did in 74, 73, 74. However, those things happen. The reality of what we do tells me that they do happen and they occur from time to time. And a hedge means you're taking the risk down near zero. You're not, if you're making money on the hedge and you're making money on the stock portfolio, then you're not really hedging, you're speculating. Something's going on there. You're over hedging. Like if you have $100,000 worth of portfolio and you put in place $200,000 short on your hedges, and you end up with a big downside move and you make a bunch of money off the futures hedges, and then you buy them back and then you let your stocks go up again, that's not hedging, you're speculating because you did too much of the S&P futures. To hedge means to balance, to take you to just out of the market. And I think that that's, it's appropriate to do sometimes in some strategies, depending on how you structure your life and all that. The problem I got with just hedging is something that has to be thought about, even though it's been an awfully long time since it happened. Nobody that's trading now probably has firsthand experienced it. If you have a depression-like situation that where you have an economic downturn that is really, really severe and lasts for a lot more than just a year or two, try 5, 6, 7, 10 years, a whole decade. Japan's suffered kind of a sideways period for a few decades here. Our depression back in the 20s, 30s in the US lasted a long time. If you have a situation like that and you're just hedged, you're not making any money, you're not losing any money, but that would require a heck of a lot of patience. So one of the reasons I like to dabble in things like futures and even crypto futures and other markets that potentially could move is there's potential for profitable moves in places where I'm on my stocks, I'm hedged and I'm just holding my own. And if that goes on for years, that's not going to be a great way to fund my retirement. So I'm always looking for other ways and other return streams. Why I'm so big in all-weather investing, in trying to say, look outside just the stock and bond markets. There's lots of other things out there that can produce profits.
And another thing you mentioned earlier that I also want to linger on momentarily was when you were talking about the trend following approach, that your first quote unquote hedge is simply exiting when conditions start to change, which to me makes a ton of sense. That's actually primarily what I do. And when I think about the way that I trade, a lot of the times a hedge would pretty much go on if I'm levered in some capacity. If I'm not levered, I'm probably not hedging and I'm simply going to manage the positions that I have on. When you're looking at a small account, let's say less than $10,000, and we have somebody that's, generally new to the market here, what do you think their disposition towards hedging should be? Should they do it? Should they not do it?
I probably wouldn't do it. I'd probably, with that size of account, I would stick to names that I can move quickly in and out. Your size on your positions is going to be extremely small. So you're not going to move the market to sell your positions. You could easily afford to put stops in on every position you have according to some kind of an indicator that measures the trend. When the trend goes to the negative side from the positive, then that's the time to sell it out, lock in your profits, reduce your potential for loss, and write it out in money market funds and keep trying to put more money into your account because $10,000 is hard to diversify. It's hard to get your cost structures down. You're going to be spending more for everything with the portfolio. So keep working the day job, keep pummeling money in there as fast as you can, and get your account up in size, and then you can consider doing other fancier techniques in managing risk.
Yeah. I think that that makes a tremendous amount of sense. And I specifically wanted to get your opinion on that because I know that you right now have a system that includes hedges that come on. And I think retail traders don't really understand frequently enough the impact that hedges can have, specifically depending on what they're trading. And I think a lot of them prematurely start trying to center around those as compared to focusing on things like position sizing, like you're talking about, saving, getting out in time, um, those kinds of things. Now, one of the interesting things you brought up before was the money market fund, and it made me think about, what did you think about the movement between equities and bonds? I thought that was fascinating for a time because a lot of people would use bonds as their risk off asset. And then all of a sudden, their risk off assets also crashing. You're like, well, what the hell's going on here? What did you think about that? And
Yeah,
how do you
when I
adjust to
think
that kind of
about it,
scenario?
being an old gray-haired guy, is that I think people don't do a good job of going back in history and analyzing some of the things that have gone on. We've had about a 40-year, until about a couple of years ago, when interest rates were down around zero for short-term money, and money markets were paying nothing. Uh, we've had about a 4 decade or so bull market in bonds because interest rates did nothing from 1980 and Reaganomics, when the short-term interest rates got up into the high teens. It's turned around and spent the entire 4 decades coming down, and that's going to fuel a bond market rally. So the 60-40 crowd started working out, that magic formula to uh, supposedly smooth out performance, and it's supposed to be good for your long-term financial plan, and you can buy and hold bonds, 40% and 60% in stocks, everything's fine. The problem with that mentality is that when interest rates get to zero, could they go up from there? Yeah. Could they go down from there? Kind of hard. You're kind of bumping up against a lot of problems when you start getting into negative interest rates. So all of a sudden, a couple of years ago, when interest rates started climbing, the bond market got shellacked. So all of a sudden, the 60-40 crowd takes a hit on their stocks, takes a hit on their bonds, and there's no place to hide. And so much for that risk mitigation. It's not risk mitigation if it doesn't really reduce risk. And you're passively sitting by and saying, I'm diversified between bonds and stocks, but you're not actively attacking the risk of bonds or stocks. You're just accepting whatever risk they have and hoping diversification reduces your risk. But if both go down at the same time, you have no place to hide. In the stocks, the thing that's happening with stocks a lot, and it may have fueled a lot of this rally that we see right now, is where else you're going to put your money. Young kids can't buy real estate anymore. They can't even afford it. They can hardly afford their rent. Um, the interest rates being where they are, it's hard to afford the mortgage. Even if you've got some money, then you gotta make these payments on the mortgage. You've got, I mean, stocks are the largest liquid market, and stocks in the US particularly, actually, where you could funnel billions and billions of dollars and have a shot, at least, of equaling or bettering inflation rates. Right now, if you look at like commercial real estate, I'm not so sure that'd be a great bet. I'm not sure that bonds, I mean, if interest rates at all continue to maintain a little bit higher level or go up from here, bonds are nowhere going to keep up with inflation. Stocks could, futures could. Real estate prices right now, if you have a soft economy, real estate may have had its run and is going to rest for a while. I don't know where else. I mean, you can go and try gold and silver. There's times when that moves. There's a lot of times when it doesn't. It could be the potential, but if you take the silver concept, then why just limit yourself to silver? Why not look at coffee? Why not look at crude oil, other different markets out there that you can potentially make money in. So I think commodities and stocks are the only game in town left lately where you can pile in large sums of money. And that's might be why a lot of people who put money in the stock market have fueled the rally late in the year here. And whether that can continue to go on will be another whole question.
Well, you bring up a funny point. I didn't think it was too incidental that when the Fed was talking about pausing and they softened their tone quite a bit, we saw a lot of volume coming out of Microsoft and flowing into bonds. And I think that that really highlights your exact point that a lot of people for a long time were looking at this and saying, well, I'm not going to put it in bonds. That's not doing anything. So I might as well just put it in tech, big tech,
Yeah,
specifically like Microsoft,
yeah, and hope for the best.
like a bond.
You're basically hoping for the best, and it's like you don't know what else to do with it. And you can't just leave it sitting there in a money market fund or something. So, I mean, you're losing to inflation doing that lately. So, yeah, might as well take a shot. Got nothing to lose. That's kind of the attitude a lot of people have.
Speaking of taking a shot, for the last couple questions, I want to pivot us now to 2024 in the way that you're thinking about the year ahead. Obviously, neither you or I are kind of the predictive type. I don't really try to do that myself because I always think it's more of an ego exercise than anything else. But I'm really curious how you are positioning for the start of the year. You already talked about the way that you feel we're kind of at a toppy level here and markets are getting maybe a little bit jittery. But what are you thinking about 2024? Are there any major themes that you're curious in seeing how it plays out?
Pretty much the same themes I always do. I'm always looking to try to play the upside of the exchange traded fund markets. I've got 30 out of 30 long stops behind every one of them, moving them up every day as I can. I've got the hedge ready to go, and it's a lot closer than it used to be. The indicators are keep trying to move it up every day. So this hedge trade that I took off and allowed the sectors to run has turned out to be a very profitable buy signal, obviously. But sooner or later there'll be a sell signal, and I'll put the hedges back on. Right now, I'm just trying to keep moving the stops up every day on that hedge so that I can get it on as soon as I can justify. So that'll be another theme. I think the other theme that I wonder whether wouldn't be something to consider in my portfolio. I'm seeing a lot of this in strange things like aluminum and I don't know, some of the softs and so on. When you get economic disruptions and you get some things like inflation, or you get supply or demand interruptions by things like the Red Sea shutting down to shipping, and you're logistically disrupting commodity flows around the world and energy flows around the world, you can create situations where futures and commodity prices will move. So I'm hopeful. I've added a 10th strategy just in the last week in my IRA that's going to be a short-term future strategy. It's going to be based on 3-day indicators. So it's going to do a lot more trades, but I'm
Yeah, it
trying to
really should.
build the automation. I'm going to try to support that with automation so that I don't have to do too much work. And it's going to trade about 21 markets, I think I figured out. And what I'm hoping happens is that if we get, and that's a big if, I don't know if the stock market's going to keep rolling or not, but if it turns over and it heads to the downside, then I would say my sector ETF programs are going to be sitting in cash a lot, and I'll be hedged on the part that is still long. And generally speaking, in a down market, that strategy is going to be swimming upstream, have a tough time. But I'm hopeful that some of the economic disruption could affect things like energy markets and say the bond market maybe and stuff like that, and I can exploit that to try to produce profits there to offset the struggling over in the sector timing. So that's kind of my theme early on here, is to kind of be very alert and prepared to go the other way if this thing runs its course and decides to turn. And if it doesn't, to enjoy the ride to the upside. That's pretty much the way
Yeah.
I'm going.
One other question I had for you is this year when we saw some of the weakness in the broad market, like the S&P 500,
Mhm.
something like the Qs in tech just kept plugging away. And when I see how heavily anticipated the integration of AI is, and I am a believer that it's the kind of thing that is a massive unlock for tons of things, but it's obviously very early and we still don't really know how it's going to be integrated and regulated, da, 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 da. But I'm curious if you think going into 2024, if you start to see some of that weakness that you're thinking of, would that lead you then to essentially rotate over short equities writ large, or do you still hold bastions that might still be performing well, like tech, that could be fueled by AI?
On my NASDAQ trading, I would just go short. I go long or short all the time. So if it goes over to the downside, and I run that on a 9-day indicator, um, it'll go short pretty quickly. And if the thing falls apart and gets really ugly, I will just coin money with that strategy. In cryptos, if the NASDAQ type companies, the tech companies, start going to the downside, it seems like over time, cryptos and tech have been related to each other, except recently. So it's been interesting. There's been some different things happening in the crypto world that I think have broken it apart from just straight whatever the techs are doing. But we'll see. Maybe it goes back to doing the same thing as techs and goes down too. If it goes down, I'll short crypto futures. No big deal there either. Hedges beyond. I'd reduce my exposure in the long ETFs, so that now is getting more and more money market funds. And then on the rest of it, just try to be looking for disruption in energy markets or disruption in the cocoa markets or the coffee markets or whatever, soybeans, corn, whatever. There's lots of opportunities out there. You just got to look for them and get your indicator set up and peel off a portion of your money to that particular strategy. So that's kind of the way I think I try to protect myself and try to look for profit opportunity. Because ideally speaking, I'd like to make money every month
Sure.
trading. Never done that uh, for a very, very long period of time. There's always drawdowns that I've had to live through, and I've lived through a lot of them. But the I think the goal is to try to keep squeezing those drawdowns down in both magnitude and in length of drawdown, length of time in the drawdown. And I'm closer to it today than I was 20, 30 years ago for sure. So I think I've done some things in the right direction. And I think that allows me to approach a year like 2024 and realize that, hey, things could get really, we could have more of the same and break open the champagne, or this thing could fall apart right after the New Year's Eve celebrations are over and they're cleaning up, and all of a sudden we're off to the races to the downside. Who knows? And
Right.
like you said earlier, you don't predict, you just react. And the key is to be prepared to react. If you're sitting there saying, I'm loving this up market, and you decide to just leave your portfolio in place and go take a 2-week vacation to the Bahamas or something and enjoy some of your the rewards that you've made on your portfolio, and you leave your portfolio exposed and it decides to go the other way, it could happen so quickly that by the time you get back, you might have a lot smaller portfolio. Um, you gotta put the things in place and you gotta run them and you gotta be prepared to pull the trigger. You can't hesitate. When the target is in your sights, pull the trigger.
That resonates pretty well. One last question for you. Does an election year factor in differently when you're thinking about the year? Because that is one thing I consider quite a bit, especially the way that we're positioning how the economy is doing and how inflation is doing. I don't like being too tin hatty, thinking, that there's a lot of subversion going on, but I do think of it as there's probably a bit of window dressing happening right now. How do you
Yeah,
think about an election year?
in an election year, to me, it's all about, say, news items and world events and all that. And an election year carries with it, by the very nature of it, some news events that could potentially affect markets, especially if the markets were extremely overextended to the upside and looking for an excuse to sell off. All it would require, is something that, like an anti economic growth candidate coming up in the polls or something, or winning the election or something like that, and then everybody panics. It just becomes a catalyst for movement. It may not really, when you think about it and figure it all out, really mean that much to the economy, but it becomes the trigger. It becomes just the catalyst for movement. And once the movement starts, the trend takes over, panic or euphoria sets in, and the markets are good at perpetuating those things. The Wall Street Journals of the world, the daily, what do you call it? The Investors Daily, Business Daily, IBD.
IBD, yeah.
Um, all of those types of publications, including all the CNBCs, the Fox Business, all those, they're all going to be catering to whatever direction the market's going. If everybody is depressed and the market makes new lows every day, then you're going to hear a lot of stories about how rough things are and the economy is still looking bad and the Fed's trying to prop it up and doing this, but so far it isn't working. And you're going to have very negative attitudes, and the trend down tends to perpetuate itself. But the same is true to the upside. If the market's making new highs, then it's a bunch of smiley faces and giggling, and everybody's happy, and every stock, they're going over the stocks that gapped open 5 and 10% that morning, and it's a different type of mood that you're watching. And I think those publications are just feeding the viewership what they want to hear. And so that's how trends tend to perpetuate themselves. And I think election years tend to provide some catalyst for movement. So yeah, you never know. Could easily, there's all sorts, the conspiracy that the Fed tries to keep interest rates low during an election. I don't know. That just might be the timing of the economy. I don't know if they can actually more accurately do that and pull it off. I think you can, obviously, they kept the interest rates too low too long, I think, during COVID and after COVID. And now I'm worried that they're going to do the opposite. They're going to keep interest rates a little too high for too long, and we're going to end up slipping into some sort of maybe a medium to hard landing. And if we get a bad economy going and we're at war at the same time, that could get, I don't know, kind of ugly, I think, out there in the world. So I hate to be a pessimist, but I like to be prepared.
I think it's the best way to behave as a trader, and obviously you've been at it for a while, so it's been working for you, being prepared. But
Yeah.
Tom, I'm stoked to have connected with you. I love kind of distilling down some of the information that you have and drawing on your experience. It's one of the most beautiful things of doing this. So thank you so much for taking some time to hang out with us. I have links to your Twitter page or X page, whatever we're supposed to call it now, your website. Both of those will be in the show notes below. But is there anywhere else that you want people to get a hold of you at?
No, those would be, Twitter's probably the most frequently found place. I'd say I'm most active there because I've got 52,000 plus followers. And so unavoidably, I get a lot of comments and if I post something, I'm going to get, like, I just wished everybody a happy new year. I think I got like 100 people commenting or reacting to it. So that's probably where the action is. Facebook, a lot less. And Facebook is starting to kind of perturbed me a little bit with all the imposters. We have a known imposter that
Mm,
is actually contacting people on crypto scams. Facebook doesn't seem to be able to get rid of the guy. And
frustrating.
it's just really kind of, I don't know, pissing me off. LinkedIn is pretty solid, but is a little bit more business oriented, I'd say. So I do have followers there. I've got probably 1,000 or 2,000 people there, but certainly isn't the size of Twitter. So that's the easy way. And Twitter, I am at Basso, Basso underscore TOM, Tom. No other spelling is allowed. It would be an
Yeah.
imposter. And
Well,
be careful out there. I don't sell you anything on direct messaging. So if somebody's trying to sell you something, it's not me.
well, beautiful. Yeah, I'll make sure I get the right links in there so everybody can find you. But yeah, Tom, absolute pleasure hanging out. Thanks for chatting with us.
Well, and have a great 2024 and hopefully a great Happy New Year's Eve.
Thank you, sir. I'm sure we'll catch up soon.
All right. Thanks, Eric.